Yo, what is going on, guys? So today we're going to be going over the Greeks of options and everything you need to know about that. And like I said, I'm not going to go over everything. I'll just go over the Greeks. I'll go over the three most important ones, and I'll go over the open interest and implied volatility. And I'm not going to refresh your guys' memory. Like, I'll refresh your memories a little bit from last video, but hopefully you understood last video by now. I don't want to re-explain everything since I already explained it in last video, so make sure you watch that. So I'm going to be going over the Greeks, like I said. So when we go to the chart, we go to the options tab. This is where options are in Webull. I explained that last video. And remember, these are in the money for calls, and these are out of the, in the money for puts, and then these are out of the money for calls, and then these are in the money for puts. Why? Because if you look at the price is at 69.69, and the strike price of 70 is over that. So that's why it's out of the money for calls, and calls means you're going along. And then it's also under the price is 70, so that's why all these prices under 70 are out of the money for puts, because puts are basically going short. So hopefully you understood last video. Make sure you DM me on Twitter if you have any questions about it. But yeah, so we're going to be going over the Greeks. So if we go to this chart and we use this line right here, I'm pretty sure there is a way to turn on. So if we go to this green line, like these three lines right here, and it goes to available items, we can turn on all the Greeks right here. So we have this Greeks options right here. And then you can click done. So make sure your Greeks are turned on. Just so you guys know, I do not use Greeks. I don't care about them. I day trade. I don't hold options overnight, so they don't really matter if you're day trading. These are only applicable if you are swing trading, in my opinion, or holding overnight and you want to know the risk with like Theta. So yeah, so first let's go over Delta. So this is Delta right here. It's next to Gamma in open interest. And if we look at this if we look at this 70 call and we go under Delta, we see this is 0.48. So what does that mean? So basically 0.48. If we go to the bid right now, it's at 0.96, which is basically $96. I'm going to refer to this as dollars from now on. So this is the $96, and the Delta is at $48. So that means every single time, let me try to get back to where it says the price real quick. So 69.69. So that basically means every single time Activision goes up $1, so say it goes from 69.69 to 70.69, that means that this bid, let me go back to this bid, my bad. This bid at $96 will go up $48 because the delta is 0.48, which basically means $48. So the delta means it goes up this amount for every dollar the stock goes up. So that's pretty self-explanatory. So say the delta was 0.25 and the bid was 0.20. So that means every dollar the stock goes up, the 0.20 will go up $25. So it'll go from 0.20 plus 0.25 equals 0.45. So it'll go from $20 to $45. So that's pretty self-explanatory. Now Gamma is how much Delta is affected every time the stock goes up. So Gamma basically means this. We see this is 0.09. It's basically 0.10 if we round it. So let's just call this $1, or let's just call this $1 right here, or $10. I mean, so this is 0.09 is $9, and then 0.1 is $10, as I mentioned before. So this is $10 and this is $48. So basically that means every time Activision goes up $1, so say it goes from $70 to $71, Delta will go up $10. So Delta would go from 0.48 to 0.58 if it went up $1. So Gamma is very important. And if you look here, there's not really any trend with Gamma. Like this is $10, this is $6, and then as we go even further out of the money, this is back to $10 again. This is $8, $5, $5, and there's a little bit of a trend. It decreases, but right here it actually goes from up to down to up again. So that's kind of interesting. But basically, that means every dollar the stock goes up, the gamma will go up for however much this is. So the $48 will go up $9 for if this goes up $1. And so what does it mean if it goes up 50 cents? Well, if it goes up 50 cents, this $48 will go up probably to like 0.55, but it won't go up it won't go up $10. It'll probably go up like $5. But it's like I said, it depends on the situation. You really need to be watching the chart and watching how the price affects it. So that's what gamma does. Gamma affects the delta and tells how much it's going to go up. And then finally we have theta. So theta is everyone's favorite. Not really, everyone hates theta. Theta is basically time decay. So this is why it's more risky playing options and shares, because if you play shares, they don't lose their value, just you're trading the share price. Premium prices on these options lose their value. So if Activision just stays at $70 and doesn't move, the premium prices are going to go down. But if you're trading shares and the share price doesn't really move, it's not going to go down or up. You're still going to be break even, right? So if you're trading options and there's data in everything, that basically means that your option values are going to decrease if the price doesn't do anything, or it goes in the opposite way of whatever you're playing. So say it just stays at 70, this data will make the stock price go down $10 every single day. So pretend next week this stock price stays at 69.69 every single day, doesn't move. That basically means this $96 every single day will decrease $10. So the $96 will go to $86. And each day, this is what you have to understand. Each day that goes by, like, so this will go from 7 days to 6 days to 5 days. And when you're on like Thursday, each day goes by, theta will increase and decrease the option value of the price even more, because these will become more worthless if the price doesn't move as you go from Monday to Friday, because you never want to hold an option when it expires worthless. So people are selling them by then. There's going to be no volume in these. No one's going to want them because they're out of the money. Why do you want out of the money contracts? I explained why you don't want them out. I explained why you do not want out of the money contracts last video. Hopefully you understood that. But data is going to keep increasing, and like say Monday, data is $10 and the option price is, the premium price bid is now $86. Maybe the next day data increases to like 0.15, so that next day it'll make it go down 0.15. And as you notice, these datas get smaller and smaller, and the only reason they get smaller, like this is $3 compared to this is $10, and this is more out of the money, so you'd think data would be more here. But if you look at the bid and ask at this $3 mark at the 76, the bid and ask is $9 and $18. So this is significantly less than this $96 and $100. So data is not going to have as much of an effect on these, because like they're already decreased so much in value, and they're almost like they're so close to zero that data is not going to really do anything to them. Not as much as it would at this at the money option. And I told you guys that these are in the money. These are in the money calls and these are out of the money calls last video. But you guys have to understand what at the money means. At the money basically means if ATVI went to 70 and it was sitting on 70 would be at the money because it's on top of the stock price, or like anywhere near you can consider at the money. But totally forgot to go over that. So that is the three Greeks you need to know: theta, gamma, delta. And theta you need to be aware of, especially if you're holding overnight. And like I said, these are gonna have less theta than these, because by the time they're almost close to zero, they really can't go down much more. So like the theta is not gonna really matter by the time, because they're already gonna be almost worthless. So let's go over the open interest and volume real quick. So if we go to, and implied volatility. So if we go to open interest, do you see, this is open interest. Do you see all these numbers? Generally, people say to buy contracts to have more volume than open interest. And basically what open interest is how many, I did some research on this a little bit before because I don't look at open interest, but it basically means how many contracts are out there like to buy and sell, but they are not liquidated. So people have them, but people haven't exercised them, or they haven't sold the premium, they haven't sold the contract. So they're basically just out there and people can sell these anytime they want. So this is quite a bit of open interest. And let me go to like SPY and show you guys. So if we go to SPY, and we go to next week's thing, and we go to near the at the money calls, and we look at the open interest. The open interest is at 4,800. So this means that let's look at this 470. So this 470, the open interest is 17,000. So that means there's 17,000 people that are want to buy or sell, like have the ability to buy or sell these contracts. And like I said, this isn't really important. I'm just explaining this to you. And the reason why people want more volume than the open interest, so we see the volume, this volume on SPY is 66,000, and we see the open interest is only 20,000. So clearly this is more than this, right? And the reason you want this to be more than open interest is because these contracts will be more liquid because there's more volume, there's more buyers and sellers, so you're likely to get filled much faster, rather than if the volume was less than the open interest, then you might have a harder time getting your contract filled, and the spread will probably be a little more wacky. So if we look at basically the spread means like the amount of money in between the bid and ask, and we see the bidder here is 0.51 and the asker here is 0.52. So there's literally nothing in between. You can't buy a contract for 0.525 unless like you average down somehow. But like you can only buy 0.51 or 0.92. But if we look at this 0 day, let's go to like Target real quick. If we look at this option chain on this, do you see how this bid is 0.01 and this ask is 0.09? That basically means that the spread, like you're not gonna get filled at like 0.0. Say you put a bid at like 0.02 or 0.03, you're not gonna get filled there. You're probably gonna get filled more at like 0.05, 0.06. So if we look at Target, if we look at this 262.5 call, we see the volume is 873. And the open interest is 781. But let's go to this 265 one. So we see the 265 strike price, 0.01. Actually, that is not a good example. I'm sorry, guys. So we go to this. Let me check. Open volume. All right, so we're going to go to this 270 call. So if we go to this 270 call, the bid is 3.5 and the ask is 3.7. So the mid price is 3.6, and that's where you ideally want to get filled. But how do you know if you're going to get filled or not if you put a bid there? Well, if you check the volume and open interest, this is open interest, and then this is volume. If we look, the volume is 940 and the open interest is 3,796. So that means that you're probably not going to get as good as a fill price as you want because there's not a ton of volume on this stock, because the open interest is more than the amount of volume there is. So just keep that in mind. I don't really use these at all. And if we go to like a Twitter, like say, why is open interest and volume important? I bet you it'll give us an answer on this site. All right, so also just so you guys know, volume is a number of contracts bought within like a given period of time. I didn't explain that. So the more volume, the more liquid it's going to be because there's going to be more buyers. So open interest says it's the total number of open contracts. So they're open contracts, but they're not specifically sell or buy contracts. No one knows. So like that's one thing you have to understand. And also if we look right here, when an option is not very liquid, the spread between the bid and offer will generally widen. So like I said, it will widen, and we can see it's widened right here. And compared to the SPY calls, they're like right next to each other, but these are 0.20 off. So that's important to know. And then there's another site that I saw right here. So open interest also gives you, there's no open interest, there's no secondary. So this says if there's no open interest in an option, there's no secondary market for that option. And then when options have significant open interest, it means there's a large number of buyers and sellers out there. So this says, so if we go to the open interest right here, 1,600, that's a lot more than all these, or we can go to this 4,000. That means there's a lot of buyers and sellers, but it doesn't mean there's a lot of buyers and sellers actually selling the contracts within the given period of time. And that's where we have to look at the volume. So we see there's a lot of buyers and sellers, but we see that they're not all trying to liquidate their contracts at that moment. So you're probably not going to, you might not get filled right away is basically what it's saying. So it says, for example, if you look at options in Apple, you see the open interest is 12,000. This suggests that the market in Apple options is active and there may be a lot of investors in the marketplace who want to trade, but that doesn't mean they do trade. And then the bid price of the option is 1 and the offer is 1.05. So bid 1, ask 1.05. And with all this open interest, that likely means you can get a fill in between, so like at 1.02 or 1.03. But if there's no open interest, then you're probably not going to get a good fill, and it's going to be a lesser, like it's going to take a little while for you to get filled. And then it says, on the other hand, suppose the open interest is 1. So basically that means like the open interest right here, pretend it goes from 3,000 to just 1. That means that this indicates there is very little open interest in those call options, and there's no secondary market because there are very few interested buyers and sellers. So that makes it difficult to enter and get a good fill price. So I'm always watching volume and open interest. You want there to be quite a bit of volume and open interest, but you generally want more volume than open interest in your contracts, especially if you're looking to swing trade. And you'll notice that contracts at like psychological levels have generally more volume than like 262, like the 0.51. So this is 262.5, and then this is like an even number, so this is 265. So this will probably have more volume, and I haven't even looked. And if we go to volume right here, yeah, 1,500 and 506. So this has more volume, even though it's more out of the money. And generally you do see more volume on the closer to in the money ones, but because this is a psychological level and it's an even number, this has more volume even though it's a little farther out of the money than this 262.5 call. So I like to take these even numbers. I don't like how these contracts move the 262.5 calls because sometimes there's a lot of volume on them. So that's another thing to keep in mind. And other than that, that's basically all you guys need to know about options. Just know that basically you're trying to read the direction of the stock. And if you think it's going to go up, buy calls. If you think it's going to go down, buy puts. And if you guys are doing this on Friday, generally on Friday and Thursday, the data will be horrible. So you want to buy like as close to in the money as possible. Because if you think the stock's going to go up and it's a Friday and the stock's at 260 and you want to buy a 290 contract, this is probably going to be worthless because people are not going to expect it to go to 290. But if it does go to 290 on a Friday and goes to in the money, this will be 1,000% gainer because no one expected it first. So this premium price will go up very, very quickly. So that's basically all I need to know. Let me know if you guys have any questions. If you guys know how to trade options, let me know if I missed something. Hopefully I got most of it down. And you guys do not need to know about exercising options at all. That's not really important because no one does that. Everyone trades it for the premium, basically however you trade for the shares. So that is all. I hope that helped, and I hope you guys have a good resting night. Make sure to use my Rebo referral and tell your friends about this YouTube channel if they need help investing stocks. But yeah, have a good night, guys. Peace out.